Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about how interest rates affect your financial situation. And we've heard a lot about interest rates in the news most recently. For the longest period of time, since the Great Recession of 2008, we saw interest rates go down significantly. And the reason there was an attempt to stimulate buying, getting the economy going. If interest rates are low, people will borrow money. It makes it cheaper to repay that money. But then most recently, we also saw interest rates go up, and then within the last week or so, they went down again. But interest rates started going up. Why? Because there was talk that the economy was overheating. What happens if you get an economy that is running on all cylinders, and it gets to a point where there is more demand than there is supply, you can get into inflationary areas. So what happens there is you start to look at, then unfortunately for a lot of people, an increase in interest rates. So we're going to talk about, specifically how interest rates affect you. They affect your debt. They affect your investments, spending, and so on. Tyler, let's give a little history, a little bit deeper than what I was talking about on interest rates.
Yeah, now seems to be the right time to talk about interest rates. And today we're going to talk about how interest rates affect your financial situation. And the reason why right now is because, first off, interest rates have been cut about a month ago. So during late July of 2019, the Federal Reserve cut interest rates for the first time since 2008. So going back, over 11 years, which of course in 2008 was during the Great Recession. So that was the first time that interest rates were cut since 2008. And after raising rates 9 separate times in 3 years, the Fed cut rates due to concerns about a slowing economy after the last rate increase in December sent the stock market plummeting downward. Interest rates, so they're now back to historically low levels, which the bad part about that is that it doesn't give a lot of the banks wiggle room in the event of a recession or an economic downturn in the future. So right now, the rate cut, what it can mean is that it can give some reprieve in borrowing costs. So if you have a mortgage, student loans, credit cards, all things that we're going to get into, but savings rates might also fall at the same time. And in addition to that, interest rates really do affect your investments as well. So anything that you have in the market, your mutual funds, stocks, bonds, we're going to get into exactly how an interest rate increase or decrease would affect those. And again, something to pay attention to is rates have been cut just recently. So we'll see what happens coming up here in the future. But interest rates, whether they're increasing or decreasing, that depends on how the Federal Reserve views the economy as well. So it's something that affects everyone on a personal level, but also from the macro economy as well. So we're going to get into it now.
Okay, when we talk about interest rates, and most people listening to the show want to find out how interest rates affect their investments and their savings. When we look at interest rates, it is a very big factor when it comes to your investments. First of all, there's an old saying that the stock market doesn't like change. So when the interest rates increase, typically the stock market looks at that negatively. And part of the reason is it is harder for companies then to borrow money and expand and grow their business. Therefore, some of the growth opportunities diminish a little bit. So again, when interest rates increase, the stock market typically looks at that negatively. On the opposite side, when the rates decrease, the market usually likes that because it allows more aggressive borrowing from companies, so they can get and pay off their debt at a more reasonable interest rate. They have more access to money to pay down debt and to also look to expand their company. So if you get an interest rate that's going down, a lot of these publicly held companies will borrow more money at a more reasonable rate to increase their growth opportunities or possibly acquisitions too. Anything else in there, Tyler?
Yeah, so really when it comes to how interest rates affect your investments, first off, the stock market has recently viewed interest rate increases negatively. So going back just a few months to December of 2018, when it was announced that the Federal Reserve was looking to aggressively raise rates due to the strength of the overall economy. So that right there is a good thing when you think about the strength of the overall economy. And when interest rates, whenever they increase, the reason why is that usually there could be inflation concerns. So when interest rates are raised or increased, the reason being is that if you have to pay a higher rate, you're probably not going to borrow as more, you're not going to spend as much, and inflation will slow down. So that is used to counter inflation. But back in December, when it was announced that that the Federal Reserve was going to aggressively raise and increase rates, that news sent the stock market plummeting down, and it was a major contributor to stocks losing 20% in the last quarter of 2018. So the market reacted really negatively to the news that there was going to be aggressive increases in 2019. Now, reason being, kind of like you said, Dean, is that sharp increases in interest rates, they can hurt businesses and cut into their revenues and profits because higher rates tend to lead to higher borrowing costs. So if a company is borrowing, there's big Fortune 500 companies that they borrow hundreds of thousands, if not millions of dollars every single day. And if they pay a very low interest rate, they're much more willing to do it because they can borrow at a low rate, turn around and spend that money and then make a higher return on their investment than what they're paying for it. But then if the borrowing costs are more, companies won't be willing to spend as much, and that is what's usually that's what is viewed as a potential economic or growth slowdown because companies aren't spending as much. They're having to pay higher rates. And when you have those growth slowdowns, investors, they won't get as much stock price appreciation, and the estimated future cash flows of that company will drop, which that in turn then lowers the company's stock price. So really, whenever you hear an interest rate increase, that is never good for, I shouldn't say never, but typically that's not too good for the market because interest rate increases usually have a negative effect on any type of stock investments that you have. Now, on the other hand, an interest rate decrease, which is what we've seen most recently here, that's usually viewed as favorable because companies will have the ability to finance more operations, acquisitions and expansions, different things like that at a cheaper rate. And what they can do is that's going to increase their profit margins, their revenues, and when they do that, their stock price is going to go up. So usually when you can do that, when interest rates increase, that is good for the market. When interest rates decrease. And the other reason why, too, is because we've seen it going over the last 5 years or so. What happened was interest rates were right near an all-time low. And many people, if they were retirees or pre-retirees and they wanted something that was relatively conservative, they were in those investments. They were in different types of bonds, CDs, annuities, but those are all based on interest rates. And if interest rates are low, then you're not making a whole lot in CDs, money market accounts, anything like that. So what people were doing is they were moving more money to the stock market to try and pick up on that growth and to also try and get a higher rate of return because their fixed investments weren't doing anything for them. So something to keep in mind is usually when interest rates increase, the stock market views that as negatively. When interest rates decrease, usually stocks go up during that time.
Okay, and as Tyler says, the market views interest rate increases or decreases very seriously. We see trends happen as interest rates increase or decrease, but they do affect certain investments or retirement plans or cash positions. So for instance, bond prices, this is the one that a lot of people talk about. Bonds are affected by interest rate increases or decreases, but also if you have a decrease in interest rates, your CD rates are going to go down. So for a while there, we had people that were finally starting to get decent CD rates for the first time since about 2008. And then most recently here, again, the interest rates have been gone. They're dropped a little bit. The Federal Reserve dropped them. Therefore, we're seeing CD rates go down. Treasuries are affected by interest rates. Preferred stock. A lot of people don't realize it, but preferred stock acts a lot like a bond when it comes to interest rates. And annuities. If you have a fixed annuity out there, many times you are not able to get a decent rate, of course, when interest rates start to decrease. So you need to look at your financial plan and make sure you're diversified, because there's a risk. It's called interest rate risk, that we see people make a mistake quite often with interest rate risk. As they get older, they look at some investments that are very, very safe, cash positions, CDs, some annuity products, again, treasuries. And what happens, it sounds good, feels good when you're putting money into these safe havens, but unfortunately, after a couple of years, and if you start seeing interest rates decrease, you are going to find out that many times you're going to outlive those particular buckets of money that carry that interest rate risk. Tyler, let's explain a little bit, though, about bonds. We hear a lot of people refer to bonds a lot, and really a lot of people don't understand how they are affected by interest rates.
Yeah, really good points there, Dean. Usually when we talk about interest rates, people forget about bonds or different types of conservative investments like bonds, CDs, treasuries, annuities, but they have to realize that those are all those are also affected by interest rate increases or decreases. And especially when it comes to bonds, there's an inverse relationship between interest rates and bond prices. So whenever interest rates whenever interest rates decrease like they have recently, that means that bond prices go up. So again, there's that inverse relationship, but the bond yields go down. So what that means is that investors, they have a decreased opportunity to make money from interest. So many investors might shift from bonds to stocks when interest rates are decreasing, because what happens is with a bond, bonds pay out a certain yield or a percentage that you get each and every year as income, and there's plenty of retirees that like to use those, their bond interest as income. But when interest rates go down, bonds pay less in interest. So people don't make as much when interest rates are lower as they have been over the last 5 years or so. Again, now they've been gradually increasing until just recently they went back down again. But many people have seen that where with their bonds, they're not yielding as much interest at all as what they were some years back when interest rates were higher. So again, when we see that where bonds aren't yielding as much when interest rates decrease, usually people go, or some people might go and shift their money from bonds into stocks, which is part of what causes the stock market to increase during times when rates are decreasing. So on the other hand, then, if interest rates increase, bond prices decrease, but bond yields go up, which means a bond can pay out more interest to investors, which can make them more attractive for retirees and different income-oriented investors. So when interest rates do increase, the yield that you get on your bonds will probably increase as well. So that's something where if the stock market were to go down, if interest rates were to increase, then we do see many people going into bonds to try and get that higher yield. And also remember that stocks usually go down during that time as well. So interest rates play a big part in bonds, CDs, treasuries, annuities. The main takeaway is that whenever there's a rate decrease, you're usually going to see your rates decrease, the rate of return that you're getting on your CDs, bonds, treasuries, annuities when rates go down. But then when rates go up, you're typically going to see a higher yield as well on your money market accounts, your CDs, treasuries, annuities, bond prices. So there's direct relationship between interest rate increases and decreases and your different conservative investments as well.
Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, now we're going to look at how interest rates affect things such as credit cards. Unfortunately, we talk to a lot of people that have significant credit card debt for whatever reason, but interest rates also affect that. And what I mean by interest rates, not the not the specific interest rate that is determined by the credit card company, but the Federal Reserve, when they determine whether there's an increase or a decrease in interest rates, across the board, different companies and sectors make those decisions proportionately. But it's quite interesting how interest is determined with credit cards, whether it increases or decreases. Tyler has some numbers here that I think are quite interesting when it looks at what interest rates do with credit cards.
Yeah. So what we're going to explain next is how the interest rate decrease that we just seen recently could potentially affect your credit cards. Now, the interest that you pay on your cards will probably go down a little bit with the recent rate cut, but just some background on where we're at right now with credit cards. According to bankrate.com, credit card rates now currently stand at a record high of 17.85% on average. So that's the credit card rate that you would pay on any debt balance that you carry on your credit card on average. Of course, some are going to be higher, some are going to be lower. But as you can see, 17.85%. We don't like credit cards at all and definitely don't recommend keeping any debt balance on them because that's the highest type of interest that you're going to pay out of any of the debts that we're going to cover here, which is almost 18%. So, of course, definitely try to not keep any debt balance on those. One other interesting thing is over the past 5 years, the average interest rate charged on credit card debt has increased by 35%. So in 2014, it was right around 12% was the average credit card rate. Again, right now it's close to 18%. But that makes sense because rates have slowly been rising over the last decade up until now. So it would make sense that we've seen an increase until now. And then according to NerdWallet, almost half of all credit card holders do not pay their bill in full each month, which again, we recommend if you are going to have a credit card or if you are going to put different expenses on there, then anything that you put on there, pay it off every single billing cycle. Don't keep any debt balance on there. But so again, almost half of all credit card holders don't pay their bill in full each month, which means that the average household with credit card debt pays over $1,150 per year in credit card interest, and they owe an average of $8,390 on credit cards. So anyone who uses a card, half those people carry a debt balance on them, and on average, the average American has over $8,300, almost $8,400 per year that they have in credit card debt. So those are things that we definitely don't like to see, especially considering the rate that you pay on that debt balance, which is outrageous compared to any other rate that there is. But overall, when it comes to credit cards, a rate decrease could mean a slightly lower rate that you pay on your credit card debt, but even more importantly than looking at this interest rate decrease and thinking that your credit card rates are going to go down is the fact that if you have a credit card and you carry any debt balance on it, you probably shouldn't in the first place. If you're prone to racking up credit card debt, try to not even use a credit card just because at a rate of 18% is the interest rate. Over time, that can pay up, and you can see why a lot of people who get into credit card debt just can't get out of it because of the rates that they have to pay and try and come back from. So we firmly believe that if you have a credit card, pay that debt balance pay it off every single month. Don't carry a debt balance on it. That's going to help your credit score. But if you, in the past, if you had credit card debt, or if you did carry a debt balance and you haven't got out of it, or you've worked over the years to try and get out of it, try to not even use it anymore because that's an interest rate that you definitely don't want to pay.
Okay, Tyler, you brought up a couple points, and Tyler and I are SmartVestor pros through Dave Ramsey. If you follow Dave Ramsey at all, you go to the website, you'll find us listed there as his SmartVestor pros in the Green Bay and northeastern Wisconsin area. And the reason I bring this up is credit card debt really many times can be eliminated or reduced if you just have an emergency fund. And again, this is part of the reasons we recommend this to our clients when they go into retirement. Sometimes they are so in tune to just getting as much money as they possibly can into their particular investments that they tend to forget that having some cash positions are almost as important for a number of reasons. But the first reason is if you have emergency funds built up in cash, and there's a storm or something where the roof is damaged or the furnace goes out, instead of having to rely specifically on putting that on a credit card and not being able to pay it off for months, if not years, as Tyler said, the interest rate that you're going to pay on this is ridiculous. So build up that emergency fund and use that instead of a credit card, or put it on the credit card and use the emergency fund to pay it off 100% the next month. So again, that's part of the reason why we, and you'll hear Dave Ramsey talk about it, having emergency funds keeps you from dipping into this high interest rate debt, which is a credit card.
Yeah, good point there, Dean. The other thing that we want to talk about is how the recent interest rate decrease could affect your savings accounts. And now, just recently, different savers have started to barely benefit from rising interest rates. But now with the rate cut, that means saving rates could start to come down a bit again. And we've seen that just with different bonds, different annuities, CDs. They're already starting to come down, the interest rate that they're paying out. But over the last decade or so, many people haven't benefited from savings accounts or money market accounts at all. And now they're finally starting to come up with, but with the rate decrease, they could go right back down again. Now, after, again, the Federal Reserve raised rates 9 times in 3 years up until now, so they were trying to really aggressively raise rates and push those up, which does help your savings accounts, your CDs, money market accounts, different things like that. But up until now, the highest yielding savings rates had been paying over 2.5%. And those are a lot of the different online banks that you can find, but 2.5% up from, it was only 0.1% on average before 2015. And one online bank recently introduced the highest yielding account in the industry at 3%. Now, with an annual yield of 3%, a $10,000 deposit earns $300 after a year. At 0.1%, it earns just $10 after a year. So as you can see, those are pretty big differences, and that number can make even more of a difference if we use a number that's higher than $10,000. But still, that just shows that it took 4 years to climb from 0.1% to 3%. And again, that's the highest one. Many of them aren't anywhere near 3%. But now that we could see them going back down again, and so ultimately, whenever there's talk about an interest rate decrease, that will hurt those who are savers. So we see many of our retirees and pre-retirees, they don't necessarily like that interest rates are so low because it hurts them, because they have savings accounts, they have CDs, they have fixed annuities, different things that really depend and that really grow on interest rate increases. Because if there's an interest rate decrease, it's not going to affect them. They don't have a mortgage, they don't have any loans, they don't have credit card debt. So they're not necessarily a borrower at this point. So if you're a retiree with no debt, interest rate decreases on your safe investments usually won't make people too happy. But again, with the decrease, it's a small one, and you could see your savings account, CDs, fixed annuities, money market accounts start to go down a little bit.
Okay. And also, when it comes to interest rates, there are a lot of people that carry a mortgage, and mortgage, of course, is very, very sensitive to interest rates. It can work in your favor, it can work against you. The housing market is still very hot, so people are buying and selling houses, more now than they have since 2007. We went through the recessionary times, and the mortgage industry and the housing industry almost collapsed at that particular time, but it has picked up every year since. So right now, we're still in a situation where interest rates are relatively low. They were increasing pretty systematically here this last year and a half. And again, now we're starting to see interest rates go down again. So that is going to be beneficial for those people who want to purchase a house. Your mortgage rates should go down as a result of this. So for those people looking to target the time to buy a house, it looks like we will probably go through additional decreases in interest rates through the end of 2019. So again, it's positioning those people who have to take on a mortgage very favorably, whether it's a commercial mortgage or residential. Tyler, anything else when we're talking about mortgage? Does it also affect student loans?
Yeah, good observation there, Dean. So mortgage rates are already very low since the end of last year, and right now the average 30-year fixed rate is now at 3.93% according to bank rate. So again, under 4% for the average 30-year fixed rate mortgage. So with the recent interest rate decrease, it could be a perfect opportunity to potentially refinance at a lower rate if possible. Or if you're a new buyer, it would be the perfect time as well, just because this time a year ago, last year in 2018, the housing market and real estate was booming. It was very hot. But at the same time, interest rates were increasing, whereas right now it's still as hot, the real estate and housing market is, but interest rates are decreasing, which is even better for buyers. So it could be the perfect opportunity to, again, refinance at a lower rate. Interest rate decreases do affect your mortgage. And on average, if you can shave off just a 0.5 percentage point off your current rate, so 0.5%, then that would save the average homeowner about $125 per month. And $125 per month can be a big deal, especially if you're younger. If you're in your 30s, you can reroute that to a Roth IRA, for example, an investment account. You can pay down other debt. You can do a lot with $125 per month over a number of years. So just by potentially refinancing, or if you're a new buyer buying right now and locking in that new rate, could be beneficial if you're looking at a mortgage. When we talk about auto loans, the decision to cut rates probably won't have a major impact on auto financing, as those rates are already relatively low as well. The average 5-year new car loan rate is 4.72%. So probably won't affect those too much. But the rate cut lowers financing costs for car manufacturers and dealers as well. So kind of like we talked about before, these big companies, they also like lower rates because their borrowing costs go down then. So with that said, if that lowers the financing and financing costs for manufacturers and dealers, then you might have more room to negotiate on a cheaper price for the actual car itself. So that's one place where interest rate decreases could affect the auto industry. Probably won't do it too much on your auto loan, but the prices of actual cars themselves could go down a little bit. So it could help out that way. And then lastly, when we talk about student loans, that's the other one. The rate cut in student loans, most students rely on federal loans, which are fixed rate, so that they would have no effect there. But there are 1.4 million students who have private student loans, which can be affected by the rate decrease. So you might want to consider refinancing your private student loans to lock in a lower rate if possible. Some allow that, others don't. So that's something to consider if you have private student loans. But in addition to that, it's actually interesting because when we talk about student loans and the interest rate decreases, interest rates for student loans right now really aren't that high. They're anywhere from 4 to 8% depending on which ones you have. But student loan debt, there was a study, and it's now become the second largest expense that an individual would have, only behind their mortgage. So when it comes to student loans, that's a debt that you want to get paid off relatively quick. Interest rates aren't anywhere near what they are for credit cards, but an interest rate decrease, if you do have private student loans, could take those down a little bit. So potentially think about refinancing those as well.
Okay, good points, Tyler. That's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.